This is John Prasinos, Editorial Director of Investing Daily, with a video update from Monday, April 5. To view our full range of publications, visit our website at www.investingdaily.com. Well, despite pandemic-induced economic damage, investors are letting the good times roll for now. In the first quarter that just ended, all three major U.S. stock market indices rose. The Dow Jones Industrial Average by 7.8%, the S&P 500 by 5.8%, and the tech-oriented NASDAQ by 2.8%. The small-cap Russell 2000 rose by 12%. Stocks could reverse direction, of course, if the pandemic suddenly worsens, or if lawmakers on Capitol Hill lapse into their usual gridlock, or if inflation rears its ugly head and drives up bond yields. Regardless, the holiday-shortened week provided an upbeat ending to the robust first quarter, with the S&P 500 on Thursday surpassing the 4,000-point mark for the first time ever. Stocks are maintaining their post-election momentum. My first chart tells a story. Take a look. Economic reports last week were encouraging. Consumer confidence climbed to its highest level since the coronavirus outbreak, and manufacturing activity expanded in March at the fastest rate since 1983. Monetary stimulus also is shoring up the bull market. The Federal Reserve has repeatedly indicated that it has no intention of removing the proverbial punch bowl from the party anytime soon. Biden's massive infrastructure plan, released last Wednesday, also cheered investors. Americans already are getting back to work as lockdowns are eased and businesses reopen. The U.S. Bureau of Labor Statistics reported Friday that non-farm payrolls rose by 916,000 in March, and the unemployment rate declined by 6%. See the second chart. Jobs growth blew past the consensus estimate for 675,000, representing the fastest since August 2020. Gains were strongest in the leisure and hospitality sector, while construction soared by 110,000 jobs. The government also reported a 0.1% decline in average hourly earnings for March, compared to the expected gain of 0.1%. Compared to March 2020, average hourly earnings increased 4.2% versus an expected gain of 4.5%. What does that mean? Well, it means that the jobs market is mending, but not at an inflationary rate. It's the sort of Goldilocks balance, not too hot, not too cold, that keeps the bond market calm. Biden's Build Back Better package is focused primarily on physical infrastructure, with huge investments in housing, clean energy, and advanced manufacturing. A large chunk of the spending would go to transportation. See my third chart. Deteriorating roads, rail lines, and airports are a global problem, which makes spending on transportation an investment trend with multi-year momentum. The nonpartisan group Building America's Future reports that 1/3 of America's major roads are in poor or mediocre condition, and 45% of major urban highways are congested. A recent analysis from the American Road and Transportation Builders Association has found that over 47,000 bridges in the U.S. are falling apart because they're, quote, structurally deficient. Federal infrastructure spending will pave the road to profits for companies involved in public works. But it's not just in America. China and several other nations are stepping up their spending on public works, a major investment theme for 2021 and beyond. And yet, many construction sector stocks are undervalued, which means you should consider them now. Okay, that does it for today. If you'd like to reach me, just send an email to mailbag@investingdaily.com. Thanks for watching.